All right, so where we left off in the last video on Monday, I'll look at this conceptually, is on Monday we talked about converting the income statement and balance sheet to TII and TFI, right? And so, as I mentioned on Monday, it didn't matter which of those two statements we converted first, but we had to convert both those statements to then get to the statement we're going to focus on today, which is that of cash flow available to investors, or CFI. Okay, so once you have converted the income statement and balance sheet, you can then create the statement of cash flow available to investors, or CFI. So when we do cash flow, just a reminder, is basically the cash coming from the income statement, TII, minus the cash invested in the balance sheet, the change in the TFIs. Okay, so we're going to use that process 4 times when we do the statement of CFI. We're going to look at the income statement cash, and then we're going to look at the balance sheet cash, the investments, and the delta is going to give us each of the areas. So for example, free cash flow, which is the operating cash flows, is the operating cash from the income statement, the NOPLAT, minus the change in operating investment, change in invested capital on the balance sheet. That is free cash flow. Then we're going to do the same process for the non-operating cash flows. It's going to be the non-operating cash profits from the income statement minus the change in non-operating investments in the balance sheet. Non-operating cash flows. We add those two together, the ones and the twos, cash flow available to investors, CFI. To get to the debt equivalent cash flows, we're going to look at the cash payments to the debt holders, the interest expense on the income statement, minus the change in the debt on the balance sheet. That's the cash to the debt holders. Now we're going to look at the dividends to the shareholders, the change in issue or repurchase of shares on the balance sheet. That's the cash flow to the equity holders. 3 plus 4 will also equal CFI. All right. So again, conceptually, that's the process that we're about to go through as we go through this statement. Right. Now, in the lecture notes and in the book, talked about, and this is right out of the book, statement of CFI, which is sometimes referred to as free cash flow. And the book does a terrible job of being consistent, where sometimes they'll call it the statement of free cash flow and sometimes they'll call it the statement of CFI, and they're really talking about the same statement. And I'm bad too, because sometimes I'll call it the statement of free cash flow as well. But technically, it's the statement of CFI, cash flow available to investors. In addition, in the previous 2 statements we did in the last video on Monday, for example, when we did TII, we took the income statement and we rearranged it to the economic statement of TII. We did the same thing with the balance sheet. We looked at the balance sheet, we rearranged it to the TFI. There's a little bit of a misleading slide because in the book, they put the accounting GAAP cash flow statement next to the statement of CFI. But unlike the past 2 statements, you cannot create the statement of CFI from the GAAP cash flow statement. All right? So it's a little bit misleading. With the previous 2 statements, you directly create from the income statement and balance sheet TII and TFI. However, for CFI, you cannot directly create it from the GAAP cash flow statement. You create it from the TII and the TFI. Okay? So that's why you need those 2 statements first. But I will say a word about the GAAP cash flow statement. There are 2 pieces of information that we will need from the cash flow statement that are not on the income statements and the balance sheets to do the cash flows. One is depreciation. Generally, for the vast majority of companies out there, they bury depreciation in cost of goods sold. So when you look at an income statement, you don't see the depreciation on the income statement. You have to go to the statement of cash flow to figure out what the depreciation is. Now, on homework 3 and on your midterm, I'm going to give you the depreciation. So it'll be easy for you. But once we go past the midterm and you start looking at real statements, you're going to have to go figure out what the depreciation is because it's not listed on most income statements. So that's one of the items we're going to need from the statement of cash flow. The other item we're going to need from the accounting statement of cash flow is the dividends. The income statement stops with net income. It doesn't tell you the cash dividends paid to investors. And we will need that information, so therefore we'll need that from the statement of cash flow. All right. So let's start sort of the continuation of the conversion process of where we left off with the company. So as I said, we've converted TII and TFI for this simple company. Now we're going to try and create it CFI. So I'm going to jump back to Excel here. So I'm going to create a new tab, and I'm going to call this CFI section 401. All right, change my zoom. A little bit easier to see. All right, I want to line my years up so I can copy and paste across the sheets. And then I want to start calculating the operating cash flows. So again, I know you did the reading this week. And in the reading, you know that free cash flow is defined as gross cash flow minus gross investment. So we want to basically calculate our gross cash flow first. Gross cash flow is cash flow from the income statement. It's no plat plus depreciation. So from TII, we're going to take our no plat. And we're going to add in our depreciation from our financial assumptions. And those two together are going to be something called gross cash flow, also known as GCF. So gross cash flow is the 210 plus the 20, excuse me, or 230. So that is how much cash this company generated during this period from its income statement. Right. Next, we're going to subtract from that the gross investment. Gross investment is anything that's an operating investment in the balance sheet. Therefore, anything that's a change in invested capital on the balance sheet is going to be gross investment. So, gross investment also known as GI. I'm going to give you a shortcut for it. Shortcut for gross investment is from TFI, it's the current year invested capital minus the previous year invested capital. Right? So it's the increase in our invested capital plus the current year's depreciation. That shortcut will always work. So in this case, 70. Right? Now, you might say, well, gee, how did I come up with that shortcut? I'm going to show you the granular detail that gets you to the shortcut. But for purposes of your next homework, if you were to use this shortcut, that would be a correct answer for gross investment, right? Because that is 70. And then free cash flow equals gross cash flow minus gross investment. That is the operating free cash flow of the business. So, add a few rows here. What is really gross investment? Gross investment is anything that's a change in what we labeled a 1. Anything that's a change in an operating asset or liability. So in this case, equals, if I go to my TFI, I look at anything that's a 1 in the balance sheet, inventory and accounts payable, which I've netted as working capital. So really, what it's going to be is my change in working capital. And working capital went from 75 to 75, so current year minus previous year, there was no change in working capital. Right? And I can kind of eyeball that, verify that. So for example, inventory went from 200 to 225, and then that would have chewed up 25 of cash. But my payables went up from 125 to 150, so I basically didn't pay my suppliers for the inventory that I got. So there was really no impact on cash. Therefore, no change in working capital from a cash flow standpoint. Right. Next, I have my change in net PP&E. Well, for a company, change in net PP&E is called capital expenditures, or CapEx for short. So therefore, what is CapEx? Well, I can solve for it. CapEx is, if I go back to my TFI, the current year's net PP&E balance minus the previous year's net PP&E balance plus the current year's depreciation. It's the 70. Right? So you might say, well, gee, how did I come up with 70? Well, think about it this way. If I start with 300 of net PP&E and I buy 70, or CapEx, of new equipment or new facilities, 300 plus 70 is 370. If I have 20 of depreciation during the current year, 370 minus 20 is 350. That is my ending net PP&E balance. So all we're trying to do is solve to make the balance sheet balance. And so therefore, if you solve for it, capital expenditures is the change in net PP&E plus the current year's depreciation. Right? Matter of fact, on your homework assignment, you'll notice down here, row 35, near the bottom, I give you a tax rate, I give you a cost of capital, I also give you the assumption for CapEx, just as a reminder. Okay? So we'll solve for the CapEx. So when we add these together, those are the only ones on here. That gets us our gross investment of 70. 70 matches that 70. That's how I got the 70 gross investment. The reason for the shortcut, think about this. I take all the change in invested capital. One of those is CapEx. CapEx is plus depreciation. Therefore, the shortcut is change in invested capital plus depreciation to account for the CapEx. Okay? That's how we got to the shortcut. So again, we have 70 of gross investment. So the company generated 230 of cash from the income statement from operating activities. It reinvested 70 in the balance sheet for operating investments. It netted what we call free cash flow of 160. So that is our operating free cash flow, our ones. Questions? On homework 3, you will notice that there are more operating assets. Operating cash is an operating asset. This can be part of working capital. Receivables are an operating asset. Goodwill and intangibles is an operating asset. So you're going to have to do, for example, a change in goodwill. All right, so just as you do a change in working capital, there's going to have to be a change in goodwill. So any changes in the ones are going to have to be accounted for, right, when you do your homework assignment. Right, just as a result of that. So it's all the one assets minus all the one liabilities. It's the change in that. All right, so now we want to take from our operating, we want to now add in our twos, our non-operating investments. We start with the income statement. Did we generate any cash from the income statement? So off the income statement, TII, I see that I had after-tax non-operating income. That was my 2 off of the income statement, my non-operating cash flow from the income statement. Right? Now, what we're eventually trying to solve for is something called cash flow available to investors, CFI. And I just want you to start applying common sense here, right? Because as we go through this statement, and I'll just, again, on the TII and TFI, you're going to pretty much have, most of you, no problem with those statements. When you get to the CFI, you're going to struggle with this. And I don't have a hard and fast rule for how not to struggle with it other than to apply common sense. And what I mean by that is that what we're trying to create in the statement is the idea of cash flow available to investors, or CFI, which is the amount of cash that I can pay to my investors. Right, that's the amount of cash from operating and non-operating activities that I can pay to my investors. So let's just think about this for a second. If I generate 160 of free cash flow, does that add to the cash that I can pay to my investors, or does that take away from the cash that I can pay to my investors? It would add to that. If I generated $3 million of non-operating profits, would that add to the cash that I can pay to my investors or take away from that? Add. So if I were solving for my CFI right now, I sum these up, I would end up with 163 of what's called cash flow available to investors. Right? I would have generated 160 in free cash flow, and then I would have generated an additional 3 of non-operating cash flow that I could then, the two together, pay out to my investors. Everybody see that? All right. But we only, yes?
Maybe you guys just say it.
Go ahead. Questions are good.
Is that money also going to creditors, though?
No, because the creditor money is part of the working capital and is part of the gross investment. Okay. If you define a creditor as not a bank or not a bondholder. Okay. So interest-bearing creditors, which we're going to call debt, is what this goes to. The accounts payable creditor is actually part of the working capital, and that's already been taken out.
So do we need to take out the interest-bearing debt from that number?
No. Interest-bearing debt's not part of that. That's going to be the other side of the CFI. That's what we actually use the CFI to pay. That's where we're going to go to. Right? But we're not done yet, because there is one thing I didn't do, which is I only looked at the income statement impact of the non-operating. I got to look at the balance sheet impact. I got to look at the change in the balance sheet. So on my balance sheet, TFI rearranged, I had something which we called EI. I'll write it out here. Equity investments went from 15 to 25. All right, so we basically bought a stake in another business worth $10 million. Did that add to or subtract from our TFI? It's actually going to reduce the cash that we can pay out to our investors. So what I'm going to do here is I'm going to say, okay, we have a change in equity investments equals 25 minus the 15. It went up by 10, but it's not actually adding to my CFI. And this is where I mentioned the idea of common sense. You got to literally think about what you're doing here. Look at the line item and say, you know what? Is that adding or subtracting from my CFI? We just said it's going to reduce my CFI. So what I have to do if I'm adding it in is I have to flip the sign. So my CFI is actually 153. By the way, this is just an at sum of those fields. Okay. Everybody see that? So I basically generated 153 of cash that I could pay out to my investors. Now, I also want to point out a little bit of another inconsistency in the textbook. The authors of the textbook had different people that wrote different chapters. And unfortunately, they were not consistent with the way that they actually implemented their definitions of free cash flow. Meaning, the actual definition of free cash flow is gross cash flow minus gross investment. That's what I just did. However, if you look at the example in the book, it's gross cash flow with negative investments summed. So what they're doing is they're adding negative numbers. Because I know the guy that actually did this example, and he did it in Excel, and he used the at sum, and it was easier for him to just add these cells together. So he did at sum, and therefore he made outflows negative numbers. So he was adding negative numbers to get to the correct gross investment. In my example, following the actual definition of gross cash flow minus gross investment, I treated investment as a positive number and then subtracted it. Either way you do it, you end up with the same free cash flow. And to be honest with you, it's really just a personal preference as to the way you choose to do it. But I just want you to understand that in the book, you're going to see several examples of free cash flow. Sometimes they're adding the investments and then subtracting them. Sometimes they're treating investments as negative numbers and then summing them. Right? They still get to the same right answer, but they don't always do it using a consistent approach. So for me, intellectually being consistent, if the definition is gross cash flow minus gross investment, I'm subtracting positive numbers. Those are the examples that you're going to see in the spreadsheets that we build for free cash flow. Now I flip a little here when I get to CFI, because when I get to the non-operating items, I am at summing. So in that case, I'm subtracting I'm adding the negative number for change in equity investments. Okay, that gets me to CFI. But the whole point of CFI is I have 153 to pay out to my debt and equity investors. That's the cash, right? Now, again, you have to forget about accounting as you think about the statement. This is not an accounting FASB statement, right? This is a McKinsey created statement. And what they're trying to reconcile to is cash flow available to investors. What that means is when we cross the chasm and we now go to this side of the statement for debt and equity, we're going to what's called the funds flow or the financing flow side of the statement. On this side of the statement, we are trying to match to the CFI. Okay? So think about it this way. Let's say I own a business and I generate as a business $20 in profit. And let's say you own my business and I give you the $20. Well, in order for the two sides of the statement to balance, I have to have $20 of CFI and I have to show that you received $20 as a positive number. Because if I treat my payment to you as a negative number, then on one side of the statement I'd have a positive 20, on the other side of the statement I'd have a negative 20, and my statement wouldn't balance. So the format for this statement is we're trying to reconcile this cash flow available to investors. So on the financing flows, payments to investors are positive numbers. Money taken from the investors back to the firm is going to be considered a negative number. Right? So let's talk about the debt equivalents. So now we're going to talk about our threes. So for the debt equivalents, I'm going to look at the income statement debt impact first, TII, and that's going to be my after-tax interest expense. That's my three. Got consistent labeling here. Should that be a positive or negative number given what we just said? Positive 15 or negative 15? All right. Is the money leaving the firm or coming into the firm? Leaving. And since we're on the financing side, money leaving the firm is a positive number. So it's a positive 15. I have 153. I paid out 15. So of the 153, 15 went to pay interest on an after-tax basis. Everything is tax affected. Right? Now, I look at the change in the balance sheet. So for the balance sheet, I go to TFI, and what I have in the balance sheet is the debt. So I want to look at anything that's a 3 that's a change. So in this case, change in the debt. Debt went from 225 to 200. So my change was debt was reduced by 25. So practically I took 25, say millions, $25 million and I paid off the principal on my loan. On this side of the statement, should that be a positive or negative number? It should be a positive number. Because just like the interest expense, I'm giving cash to the debt holders. So I'm reducing my principal by 25. So therefore, I need to flip the sign. Okay. Last, that was the last of the debt impacts. Last part is the equity impacts. Cash from the income statement, cash in the balance sheet. Equity is tricky. Equity is where you're going to run into the most challenges initially with a statement because there's two tricks to the equity. And I don't know how to get around them other than just to talk to you about what the two tricks are. The first one resolves cash to the income statement. So I go to my TII for cash to the income statement. What is the cash flow off the income statement to the equity holders? Off the statement of TII. Which one is it? What's labeled a 4? Net income. But the challenge is net income an actual cash flow to a shareholder? No. First of all, net income is not cash flow. And second of all, net income isn't necessarily paid out. So what I'm trying to do with the statement of CFI is track cash flow, and net income is not the cash flow. So if I really think about what is the cash flow, the income cash flow that we're paying to the shareholders, what would that be? And that would actually be called the dividends. It'd be the dividends that we pay out. Exactly right. So basically, it's the dividends are the cash flow to the equity holders. So trick number one with the equity is it's the actual dividends. And that's why I mentioned earlier that you need the GAAP cash flow, because you need to know what the dividends are. So if I go back to the simple cash flow statement for this company, what are the dividends? 113. On our statement, positive or negative number? Positive, because I'm paying out the 113 to the investors. So dividends, 113, that's an equity cash flow. Right? Next, change in the balance sheet. If I look at the TFI, the changes in the fours on the balance sheet are CS, which was common stock, and retained earnings. Those were my changes in my balance sheet items. Let's start out with common stock. Did this company change its common stock? Did it issue any shares? No. So for purposes of this example, the change would be 0. I wouldn't have to worry about it. However, on your homework 3, homework 3's company will issue new shares of stock, and then it's going to buy them back. So you're going to have to deal with both of those on homework 3. So let's assume this company issued new stock, and it went from 50 to 100, or 50 to 80, just for kicks. What would happen to our CFI if it went from 50 to 80? Well, if I just did the pure change, common stock went from 50 to 80. The change would go up by 30. But should this be a positive or a negative number? It actually should be a negative number, because I'm taking cash from shareholders and I'm bringing it into my firm. So I would have actually had to flip the sign, and I'd have negative 30. Let me show you the opposite. In the accounting world, when you buy back stock, it goes into a contra account called treasury stock, or treasury shares. So you're going to see treasury shares on your homework assignment. If I think of treasury shares as a contra, just to keep it simple, if I bought back 10 of stock, so I went from 50 to 40, what would I say for my change in treasury stock? What would the cash flow impact be? Be a positive 10. Right? Because I'm basically giving the money like a dividend to my investors. Everybody see that? Okay. So for now, I'm just going to go back to where I was, where everything was the same. Nothing had changed. There's no change in common stock. Finally, retained earnings. Change in retained earnings. Retained earnings for this company, the other 4 in the balance sheet, went from 115 to 200. So equals 200 minus 115. Retained earnings went up by 85. What sign should that be? All right, let's make this a negative. So that's all my items that were on the balance sheet that were listed as 4s. That's my income statement item, the dividend that was 4s. I'm now going to sum up the 3s and the 4s to get my CFI and the financing flow side. That number's got to match that number. Does it? So by the way, on your homework assignment for homework 3, I'm not going to ask you to upload the Excel spreadsheet. You're just going to have to type in the numbers. On your midterm exam, you're going to have to upload your spreadsheet. And you're going to have matching numbers that match. So this is not a correct answer on our midterm. But more importantly, why doesn't it balance? Where did I mess up? Yeah. All right, so let's switch the sign. Does that help? Yeah. The retained earnings shouldn't be there altogether. Why not? And I'm sorry, repeating what you say just because it's for the video.
I think it has nothing to do with cash. It's just going from net income to.
That's right. You're exactly right. Retained earnings is a non-cash account. So a change in a non-cash account does not affect cash flow. So retained earnings shouldn't be on the CFI statement. That's the second trick. So if you put retained earnings and you put non-cash accounts into your CFI, it will never balance. And you'll get really frustrated. And this is how people end up spending extra hours on this statement because it goes crazy. Like, why won't this balance? And the reason why is you put a non-cash account in there, and a change in non-cash account doesn't affect cash flow. So what happens when I delete the non-cash account? Statement balances. 153 matches 153. All right. So again, let's think about what the statement's telling us. I generated 153 of cash flow to pay out. I generated 160 from operations. I net spent 7 in non-operating activities because I bought some stakes in other firms. I essentially had 153 left to pay out and distribute to my investors. 15 went to interest. 25 went to pay down some of the principal of the debt. 113 went to pay out the dividends. That's the 153 that came from the 153. The two sides balance. That's what we're reconciling to. Questions about any of this? All right, in the last section, somebody actually asked a really good question. They said, what if we issued some stock? So I'll go back to the stock issue example that we put in here. And they issued 30 worth of stocks. The stock went from 50 to 80. So we now had change in common stock of negative 30, and we had CFI of 123. How would this statement balance? And let's just assume we just put the cash in the bank. How would the statement then balance? Yeah. It's not going to be an equity investment because this is the change in the equity. The negative 30 is the change in the equity. We added 30 to our equity. So we have 30 of cash. Where do we put the cash? Yep. You put it up top. Because we have 30 in cash. Cash is either going to be operating or non-operating. In the reading for this week, the book talks about operating cash and excess cash. Operating cash, which is a 1, is the cash that you actually need to run the business day to day and pay your bills. It's cash that cannot be paid out to investors because you have to keep it in the business to pay your bills. We're going to arbitrarily call that for these assignments 2% of revenue. 1 week of sales, 2% of revenue, is basically going to have to be kept in your cash balance just to run your business day to day. Make payroll, pay vendors, you just can't pay it out. Any amount above that is going to be called excess cash. Excess cash is like money in your savings account. It's discretionary. It's cash that's going to be paid out in the future. So let's assume that this 30 is put into our savings account and it's discretionary excess cash. How would we handle it? Well, what we would do is that would be called a non-operating asset. And by the way, this is part of homework 3. You'd have a non-operating asset called excess cash. And would that be a positive or a negative? The change in the excess cash. Well, if we made it a positive, and we sum these up, 183, 123. So it can't be positive. It's got to be negative. Right? Now, here's why it's got to be negative. I want you to think of CFI like cash that's in your checking account that you use to pay your bills. The bills being the debt and the equity. All right? I want you to think of excess cash as a savings account at another bank. When I put my money into savings at another bank, I can't use that money to pay my bills. Okay? So, when I take money out of checking and I send it off to my savings account at another bank, what does that do to my cash flow available to investors that I can pay out of my checking account? It reduces it. So when you see a negative excess cash on the CFI, the company is actually taking money and just putting it into savings. So that's mechanically what would happen here. So mechanically, this company would issue 30 of new stock, assuming it didn't do anything but put the money in the bank. Its excess cash balance would go up by 30, and that's how the CFI would stay in balance. Does everybody see that? The opposite would be true if it drew down its cash reserves to pay out more stock. Then it would have a positive excess cash because it took money from savings and put it into checking, and then it redistributed it. Yes?
So is there a line item for excess cash on the balance sheet?
No, there is not. So what we have to do is we have to take a company's balance sheet where they have cash and excess marketable securities, lump them together, and figure out how much is operating and how much is excess.
And for us, it's 2%, but normally is there?
The book talks about, in this week's reading, several different ways to do it. One of them is this arbitrary percentage of sales, and we're saying 1 week arbitrary 2% right now. On your homework and midterm, it's going to say operating cash, excess cash. Operating cash is part of working capital. It's labeled a 1. Excess cash is labeled a 2. It's non-operating. You won't have to worry about figuring it out right now, but when you get to your group projects, that's going to be one of the things we're going to have to ask ourselves, which is for whatever company we're evaluating, how much cash do they really need to run their business? And then the rest of it is really discretionary cash that we'll call non-operating. But every company has at least some amount of cash that has to be operating. Okay? And there's several different methods which are talked about in the reading this week for figuring that out. All right. Now, again, that's not part of this example, so I'm going to undo all this. So at least for the video and what I eventually post as the sample that goes with the video online, you'll see that these statements match. All right, but everything we just did was captured on the video, so you can at least watch it there. Okay? All right, so that is CFI. Yes?
So if you bought back as treasury stock, would it be excess cash with money?
If I bought back treasury stock, it depends on where I got the cash from. I might buy back treasury stock because I had free cash flow and I chose to distribute the free cash flow. I might buy back treasury stock because I had excess cash and I drew down my cash to buy back the stock. So to some degree, it kind of depends on where the cash came from. And that, in a way, is why we're doing the CFI. Because later, we'll actually start to see where did the money come from that the company used to do the certain things that it does. It puts it in a much more clear way. Right? So just as an example of this, getting ready to do a presentation for a company called United Health Group, which is a $110 billion insurer. All right, so I'll be talking to them tomorrow. And using our model, one of the things I'm going to show them is their CFI. Okay, so this is real data based on their January 7th earning release for United Health Group. Change my zoom here for a second. So as part of your group projects, 25% of your group projects that you're going to do the second half of the semester is going to be to take a company, take their real data, turn it into real CFIs, have 5 years of historical CFIs, and then explain it. Tell the story of what the company's doing with all their cash flows over 5 historical years. So we're going to total it up and then put these percentages, which are percentages of the total. Okay, so just to give you a preview. So this is not part of homework 3. This is where we're eventually going with this. To give you a preview of this, I want to show you the people in the back of the room. Is this big enough to see the numbers? You read the numbers? Okay. All right. So this is a real company. So what I know over the last 5 years, the total is 5 years summed up, gross cash flow, United Health Group generated $29.4 billion of cash profit from their income statement. That's the 100%. They then took $3.8 billion of that cash and they reinvested it in invested capital on their balance sheet. Negative $3.5 billion of working capital, $7.3 billion of capital expenditures, netting out to $3.8 billion. Reinvestment rate. What's their reinvestment rate? %. They're taking 13% of their cash profits and they're putting it back into their business. Working capital, and capital expenditures. Right? Now, again, this is a formalized definition. Part of the problem with the unsophisticated rest of the world is there's a common definition for free cash flow that you'll probably hear that Bloomberg uses, which is cash profit minus capex. And people call that free cash flow. And what I will tell you is the sophisticated institutions will realize that that will not represent the true free cash flow of United Health Group. Because if I just subtracted the $7.3 billion, they would have less free cash flow, right? Because they wouldn't have as much investment, or they'd have more investment, sorry. But the point is, because they've now gotten to such a scale as a $110 billion company, they're able to beat up on their suppliers and get much better terms with hospitals and doctors and other people that they have to pay. And as a result, they're saving a lot of cash, right? So that savings of cash is a real savings to the business of almost $3.5 billion. So the real net investment they had to make was only $3.8 billion, and their free cash flow was close to $25.5 billion. So a theoretical payout rate of 87%, right? But here's the other definition of free cash flow that we're going to use in this class and then from the book that is also less used in the real world, and that is we're going to treat acquisitions as operating. If I buy another company to run them, it's like buying a piece of equipment to go sell more stuff, right? So investments in what's called goodwill and intangibles are going to be operating. So over the last 5 years, they've spent $14.4 billion buying other companies in terms of purchase premiums, right? So that means their real free cash flow after goodwill is $11.1 billion, which means what's their real reinvestment rate when you throw acquisitions in there? It's 62% because they got 38 cents left. So their real reinvestment rate is actually 62% of their cash flow, because the way that United has decided to grow their business is they found it to be better to buy other insurers. Matter of fact, they just spent $5 billion 3 months ago buying one of the largest health insurance companies in Brazil. So they said, rather than building our own network from scratch, we're just going to go buy the biggest insurer in Brazil and mold it into our operations. Okay? So essentially, that's an acquisition. It's using some of that free cash flow. So their real operating free cash flow is about $11.1 billion. Now, non-operating cash flows. What does this tell you about their excess cash? What did they do with their excess cash over the last 5 years? Went up or down? Up by $1 billion. They took $1 billion and they put it into savings. They then spent $5 billion on non-operating investments. Those are basically the equity investments. So in addition to buying entire companies, the $14 billion, they bought stakes in companies. They said, I'm going to take 20% of your company in a board seat. Okay? So rather than buying the whole company, they're buying non-controlling interest. So if you really think about their M&A, if you throw equity investments in there, they spent almost $20 billion in acquisitions, far dwarfing what they invested in CapEx. Matter of fact, almost $3 in acquisitions for every dollar in CapEx. Right? Now, CFI, $4.9 billion. What did they do with their CFI? We're now on the funds flow side. $1.8 billion was used to pay interest expense. They had debt. They had to pay it off. What happened to their debt over the last 5 years? What does this number tell you? It actually, they increased and issued new debt to the tune of almost $5.7 billion. Now you might ask, well, what am I going to get on the second part of the midterm? What types of questions might Joe ask as the professor, since this is open book, open notes? Well, part B of the midterm is going to be, once you convert the data, do you understand what you're looking at? So here's midterm question number 1. I actually asked this last semester. All right. Did this company need to borrow $5 billion worth of debt? Yes or no? Why? That's right. The real answer is they had $4.9 billion of CFI. They didn't need to borrow the money. Now, discretionary, they probably tried to create a tax shield to take advantage of the fact that they were an investment grade company with very predictable earnings being as insurer, and you had banks looking to lend to only the most creditworthy. They took advantage of that, probably borrowed extremely cheaply, and got the debt locked in at long-term rates at a very low interest rate, right? And then hold off for a second and let's see where the money could have gone. 1.99 billion, $2 billion was paid out in dividends over 5 years. They issued $2.4 billion of new shares of stock. Again, do they need to do that? No. Part of that was because of the acquisitions they've done. They've issued some shares to help with the acquisitions, right, including Brazil. Part of that was employees cashing in options, etc. But here's the key. Share repurchase. They bought back $13 billion worth of stock. How do you buy back $13 billion worth of stock when you only have $4.9 billion of CFI? You borrow the debt and the shareholder money to do so. Now I'm telling you, if you read the press releases at United Health Group, they don't say it this way. What they say is, we issued the debt to do the acquisitions. Sounds better to the banks. But what they practically did is they issued the debt to buy back the stock. Because the reason I know that is even after all the acquisitions they did, they still had more cash left than they spent. All right? You say potato, I say potato. All right? But as an investor, is $13 billion of stock buyback sustainable, assuming this repeats itself? Only to the degree that the banks will continue lending them the money. Right? Now, do I appreciate the $13 billion of stock buyback? Sure. Because what could they have done with this $5 billion that they didn't do by buying it back? Assuming they didn't pay dividends. What could they have done over here? They could have put more back in their business. And what they said is, we're going to be disciplined. Like, we're doing acquisitions, but we're not going to be crazy and just buy anybody. Like, we're going to buy selectively. And if we don't find good companies to buy and we don't have the resources to implement, then we're not just going to buy them to buy them. So we're going to be very disciplined about that. And if we have excess cash lying around, we'll give it back to you. And I'm telling you that that message resonates well with the institutional investors, because they know that the only way that they're going to reinvest is if they think they have good investments, and if they have excess cash, that they're going to pay it out. So they get sort of the best of both worlds. They get a company that's growing, and they get a company that's giving them real cash in their pockets. And right now, the banks are willing to lend because they have very strong numbers. But long term, they're probably not going to be able to buy out at this rate unless their investments improve, or unless they keep borrowing. And at some point, it's going to start affecting their credit rating. Yeah.
Might not be the case with this, but couldn't it be over the 5 years they would borrow it for this, do this, and then the next year would all...
So that's the other half of what we're going to get into later. So that's the story of the overall 5 years. And what we're eventually going to do, and this is exactly what you're going to do on your group project, tell me year by year what happened. Tell me the actual story. All right? And so you'll have to walk through that story as well. But what I wanted to show you here, and as I said, don't be thinking you have to do this for the homework of the midterm. This is after. So we're going to get into the second half of the semester. But once we put the data in the format, it becomes very clear for the analysis. It tells you exactly what's happening with the company. And it gives you a much better picture when we do the valuations. So that's where we're going with this. So again, I'll just reiterate, when you're doing your assignment, that's why it's so important right now to practice on this economic conversion stuff. Because if you understand what's going on, when we get to this stuff, it'll make even more sense, and it'll be a very powerful analysis. If you're clueless and you have no idea why numbers are going where they're going, then you're really going to struggle when we get to the analysis. So over the next couple weeks, we're going to do a lot of practice, right? But it's very important that you individually do that practice. It's going to help you to understand this stuff later. It's all building blocks. All right. I want to talk about the fourth statement. We've got about 5 minutes left. So here is the fourth statement, back to your homework assignment and back to our simple example. Create a new tab. We're going to call it economic profit, or EP. Copy over the years just so I can copy and paste. All right. So again, per the reading this week, what's economic profit? 2 methods to do it. The spread method. I take my ROIC. What's ROIC? ROIC is no plat. divided by invested capital off of TFI. That gets me my ROIC, and we are going to do what's called BOY ROIC. BOY, B-O-Y, stands for beginning of year, as opposed to EOY, which is end of year. So what does that mean? When we do our copy and pasting, my beginning of year ROIC for year 2 is my year 2 no plat divided by my year 1 invested capital. So beginning of year is the same as end of the previous year. This was referred to in last week's video. So if you could watch last week's video and read the book, you know that they said that in order for the DCF and EP valuations to balance, we have to use BOY IC. If we don't use BOY IC and we use EOY IC or average IC, we get close, but the valuations don't balance. On your final exam, you're going to have to be exact, which means you're going to have to use BOY IC, which means we're going to get in the practice of calculating BOY ROIC and BOY EP as we go through this, right? So, 56%. That's the ROIC using beginning of year. Now, I'm going to give you, for purposes of the assignment, a cost of capital. A WACC, also known as a cost of capital. I will always change this cost of capital on future assignments, because when you deal with regular companies, they don't have the same cost of capital, so I wouldn't hard code this into every assignment that you do. Same thing, tax rates always change, so I wouldn't always use the same tax rate. Pay attention to the assumptions I give you, because you don't want to destroy your grade because you just assumed everything was a 25% tax rate and then the tax rate changes. Right, so tax rate and cost of capital will vary by assignment. Right, so pay attention to those assumptions. So for this one, let's just say it's 10%. So therefore, I have a spread, which is the 56% ROIC minus the 10% cost of capital. Spread of 46%. I'm making 46% more than required to do my cost of capital, therefore I'm creating value. What is the economic profit, also known as the EVA? It's my spread times my beginning of year invested capital. I've created 172.5 million of value. I made 46% on 375 of investment at the beginning of the year, creating 172.5 of value. 46% more than my cost of capital. That's my economic profit. Method 2. I made this much profit after tax, called my no plat from operations. I then have what's called a capital charge. My capital charge is my cost of capital times my beginning of year capital. So I employed 375 at 10%. I need to make 37.5 this year to essentially pay my investors back at the risk that I took. My economic profit EVA is my no plat minus my capital charge, 172.5. Two ways to get the same answer. I strongly encourage you on all 4 statements, there are always 2 ways to get to the same answer. Both sides always should balance. Even though I'm not going to ask you to upload on homework 3 the balancing statements, it's in your interest to balance it. If it balances it, it's probably most likely right. If it doesn't balance, you probably don't have it right. So balancing is a good way of checking your work. Right? So in this case, what I do is I'd go back to Elms, Canvas, I type in for ROIC, BOY ROIC, 56 instead of 56%, and then for my economic profit, 172.5. Questions? Yes? 10% right now is just going to be an assumption. It's the assumed cost of capital. Later, we'll try and estimate for a company what we think their cost of capital is. Right? The 37.5 is the 10% cost of capital times the starting or beginning of year invested capital. Right? And that's when I say BOY, beginning of year, it means the end of last year. So in this case, the year 1 invested capital. because we're going to assume that December 31st and January 1st are the same dates.